Unsustainable business strategies lead to an overall riskier banking sector, and this will be threatening financial stability. Strategy banks have, they need to ensure their business performance is sustainable throughout the cycle, also in challenging times like the ones we face now. Even before the COVID-19 pandemic, it was already clear that a move towards online banking was key and well overdue. Banks' operating models had to change very quickly to accommodate the move to remote working as well as the fast rise in online banking usage. The only way to do this is by making effective use of modern technology, and this requires a lot of investments from banks. This shows that banks' profitability is a key target for European banks to focus on.
Information is key when it comes to a resolution, but even more so, it's key that we as public authorities are collecting information hopefully only once, and not we collected, you collected, others collected, and then surprise, surprise, we have a different assessment of the same data. 2017 then saw the SRB carry out its first resolution. We successfully resolved Spain's then sixth largest bank, Banco Popular, at absolutely no cost to the taxpayer. I've said it multiple times, if today a student looks into government bond performance in Spain in 2017, he or she will not have a clue at what point in time Banco Popular was resolved. There was no financial stability impact.
Regarding EDIS, you mentioned that this is something which needs to be done, and from my observation is there has been made hardly to no progress at all in the last 8 years. I think that's a fair assessment. What is the reason for this, and is there any other way around this? I mean, you say this is a real important point in order to complete the banking union, and this is an argument on a point we have heard a lot, but it seems to not work for various reasons. Is this something which is not surmountable, or do you see any other options how this problem can be solved?
I think EDIS had a bad start because it was a bit locked in. You mentioned asset quality at the beginning. So EDIS got a bit locked in. First, you need to reduce risk, then you can share risk. EDIS then, and I think there it's fair to say in the June Eurogroup, it became pretty clear EDIS is not on the radar right now. I think what is on the radar now, nevertheless, is to make the national DGSs fit for purpose. And perhaps there needs to be this intermediate step before you can go back to EDIS. This is why my argument is longer term, you cannot have a European banking system where then when it comes to a bank failing, you have all kind of different avenues to go. There should be also a clear understanding and a commitment that if a bank fails, it gets resolved, it exits the market, and there need to be the tools at hand to make this exit happen.
We have higher interest rates. The monetary policy is more stringent than it was some months ago, and that has an impact on the interest rates that banks can attract when they issue bonds, which might be necessary in order to meet MREL requirements. It seems like some banks need still to raise funds to meet MREL targets. What is your projection on this?
Of course, higher interest rates are first and foremost in the longer run a blessing for the banks because they will increase the interest margin and therefore profitability. But of course, also the cost for MREL issuances goes up. Now, as you also rightly said, the cost will go up, but the challenge will be different for different banks. And of course, you need to do your funding plans for good and for bad weather. And you need to do your funding plans not just for the next 12 months and hoping that the sun will shine afterwards. So I think banks were well advised. They all know that MREL is coming. that they do their funding plans. And of course, if it's getting difficult, you do the minimum. If the sun is shining, you do more.
Maybe let me read aloud now a question asked by Alistair Ryan, who's also panelist of our first panel. So the question is, Elke, you mentioned 1.8% total resolution fund available. Can we or the banks be confident that the SRB will not ask for more funds from banks in 2024?
Our reading of the text, and here we are rule taker, we are not making the rules. Our reading of the text is it's 1% covered deposits at all times. So it's basically a dynamic 1%. The big build-up will stop end of 23. Then we have reached the 1%. But with deposits growing over time, there will be a kind of a catch-up. Now it will be for the new team, it will be for next year to decide, does this mean annual adjustments, or would there be a pragmatic way of saying every 2 or 3 years you look at it, or once it crosses a certain hurdle? All this is still to be discussed. But the 1% covered deposits are not 1% covered deposits as of 23. They are 1% covered deposits anytime.
Always a question of whether banks, European banks, could do any better. And then what are the reasons that we, after 20 years since the inception of Euro, 9 years since the inception of SSM, and 8 years since we started with the Single Resolution Board, we don't see all those progresses that some might be expecting. If you compare this to Asia, with respect to Europe, you can see that the Asian banks are much better in terms of containing the personal costs, but having difficulties in the business model.
So let me start with the 4 reasons why I believe European banks are less profitable. I would start with the first statement that Europe is terribly overbanked, as it is so easy to access. We have the concept of European passporting, which basically allows you just with one bank license in one European market to access 27 other markets. So basically all banks of the planet are basically present in the European Union, which actually then comes with massive pressure on loan margins, on capital market fees, transaction banking fees. You could argue that most core banking services are basically for free, or at least do not cover the cost of equity. The second statement, very much related to point 1, is that no European bank has actually a real home market advantage. Even if Deutsche Bank in Germany or BNP in France have a strong market position, it's still a fragment of the strengths that JP Morgan, for example, draws out of the US market, or the Bank of China out of China. This long period of ultra low rates in Europe, I believe, is much deeper and much longer than what we saw in the rest of the world. And of course, everybody knows low interest rates are bad for banks, and this very long and very intense phase that we are now bringing behind us has again taken its toll on the profitability and the financial strength of European banks. And last but not least, I would point out the cost of regulation. In Europe, obviously, we have 27 national regulators and one overarching one, the ECB. However, the ECB is not even master of its own destiny when it comes to harmonization of supervisory rules, but needs instead other EU authorities, such as the EU Commission, to set a binding framework across the marketplace.
We have around the same amount of banks in Europe and US. It's about, I think it's 4,500 banks in Europe and it's 5,000 in the US itself. But the most important part here is that the US system is far more concentrated for the top banks here. So if you take the 8 biggest global systemic banks in US itself, they cover around 70% of the total assets in US itself. And in Europe, you will have to get to the top 17 banks to get to the same number for the European Union itself. And this matters for pricing power. And I fully agree with Heinz's statement that the US banks, they have a different pricing power in the US itself. The US investment banks, they earn all of their money in the US. They basically break even in Europe and they finance Asia. And that was really a consistent message that we heard from the banks here.
So pre-financial crisis, the European banks had about a 1.9% deposit margin. That collapsed to negative all the way through the 2014 to 22 period. Now that there is inflation and rates are normalising, you'll see a normalisation in the deposit spread, and that over time should increase net interest income at the banks by 70%. Look at this, Hypovereinsbank, Bank Austria. Oh man, I was young. You know, it was 2005. In fact, Hypovereinsbank bought Bank Austria in 2002, 20 years ago. Those things are still there, right? You've still got a bank with a management board and capital and liquidity. So of course Europe's inefficient, that Europe's most cross-border bank is still carrying this dead weight 2 decades later. Nobody's found a way of making that happen. And of course, you would always expect a European bank to be less profitable than its American equivalent if it's carrying that dead weight. European banks will be better. They're extremely deposit rich. They've built more than 3 trillion of deposits relative to loans over the last few years. They will keep a lot more of the deposit spread than they've done in previous times because the loans are smaller relative to the deposits. So your banking system is going to see very materially better profitability over the next 5 years than we've experienced over the last 5. It still won't compete with the US.
Since the unjustified aggression of Russia against Ukraine, indeed, we see even more the need to accelerate the energy transition, and the Commission has presented actually a number of measures, which again highlights the need indeed for additional investment, also green investment, to accelerate this transition into indeed it's also renewable energies, aside from the more transitional issues we're having at this stage. And then again, I think digital solutions can play a big role. And again, it is important and essential to see what can and will be the role of the private sector and private finance, sustainable finance in this matter. And at the same time, we do see that Europe and European citizens and businesses are more and more moving digital. When we had here in Europe now over the past years the conference on the future of Europe, where indeed also citizens from across member states were discussing and deliberating what can Europe actually do to support their lives, to make their lives better as well. The digital transition and making it indeed, let's say, responsible, making it also at the service of.
We work with banks like Deutsche Bank, BNP Paribas, Société Générale, Solaris Bank, N26. What we see for them is 2 sides of the responsibility that they're taking. One is organizing internally the house, where they're taking action to understand what does the data that they have access to translate into in terms of climate risk and costs. And on the other hand, is something that we find particularly exciting. We actually just started working on this with Deutsche Bank, is to empower the clients of the bank itself. Our software now is not released yet, but it will be embedded into the normal banking platform of Deutsche Bank. And there you'll be able as a consumer to see your CO2 emissions, to see how you're performing against the data that is available to Deutsche Bank, enhanced with our own data.
What are your approaches toward defining the ESG metrics? And what are your approaches toward defining perhaps also the thresholds? And how do you apply digital technology toward that?
One big challenge here is to determine the conformity to the taxonomy. So to really make sure that we're there in line. For that, we basically have a kind of a decision tree established, right, where we use the various attributes at hand to come to a conclusion. But we have also developed an in-house transposition path to net zero. So that's really outlining the ambition that we as a bank are giving us and our clients to move forward on.
Customers, the people out there are looking for more sustainable solutions. So they are looking for sustainable products. And that's also why we started tomorrow, right? We wanted to make it easier for people to make to get a positive impact with their finances. And up to a couple of years ago, it was very difficult. So there were a few, traditional legacy banks offering sustainable solutions, but they were really very difficult to access for customers. So from day one, we kind of said, how can digital help with sustainable? And one of the first things we said, if we want to, save the world, we have to throw a better party than the ones destroying it. Meaning we need to make it easy. We need to build a fun product that's cool to use, but still that has a positive impact.
It's really important to mention that there's still consistent issues with access to data. Parts of my team spend so much time on finding emission factors that just for like an obscure location somewhere that might have been not Berlin. So therefore, there's not an open source place where you can find all of that against paying some money. There's a few things that we openly have kind of proposed, but no one has taken an action yet, has been to make these databases actually public, because at the moment they're sheltered by companies, and that hinders the whole process and the progress. I think the EU has a big part to play of making this public source so that also more products can be built on top of that. The second one is defining a standard for accuracy. There's some countries that, due to the conflicts that are happening there, have stopped reporting on data, like let's say Afghanistan, Syria, and the data is from 30 years ago. So there's no actual update. Let's say that we don't need this data, but this is true for even some smaller states in the US and so on.
I would like to ask Andre about the general interlinkages between digitalization, sustainability, and operational efficiency within your bank. Could you confirm that these three concepts are aligned, and what may be the gains that you see and potential challenges going onward?
I can absolutely agree, and probably that's our biggest ambition when implementing it, that it is a fully integrated concept. I mean, as I said already at the beginning, for us it would be not a good idea to establish something like this as a standalone solution, with its own processes, its own infrastructure, which would then require a lot of reconciliation with other processes in the bank. That makes it difficult at the beginning, because you have a legacy and you need to find a way to kind of incorporate that in a seamless way. But I'm pretty sure that once you realize that, you have a front to back process which is technically enabled, which is seamless, and which ultimately is then not only providing the needed capacity for the sustainability part, but is also a real driver for operational efficiency.
Jan, what do you see as some of the risks and challenges that need to be addressed in the continued digitalization of the EU financial sector?
I mean, one is definitely this need to move to a more data-driven business models, and let's say in that context also to more collaborative forms of let's say of business in the end, which makes it sometimes hard for supervisors to grapple that exactly. This data, let's say, more data-driven business, and what it means for, let's say, the way you structure, indeed, a finance structure, a bank, and the way it requires you to cooperate with many more people than maybe before. I think that's certainly a key challenge I would see. And then for the operators, and then on the I think side of the supervisors, indeed, well, how do you somehow keep track of these structures?
The banking system over the last not more than 15 years has gone through so many crises. It was the global financial crisis, and we had the fiscal crisis in the euro area. I would say in the meantime, the climate change crisis became also apparent. During all this period, digital finance has been more and more important. Then we had the pandemic crisis, and at the point that we thought that this may be over, we have a new crisis now, which is linked to the geopolitical developments, these sad developments in Europe. But not only because of that, also because of the aftermath of the pandemic, we have an inflation crisis. And it is in this new environment that banks will need to reconsider how their business models can work.